சார் ஸ்டார்ட் பண்ணலாமாங்க சார்? பூபதி சார். ராணி ராணி ஸ்டார்ட் பண்ணுமா? ராணி ஸ்டார்ட் பண்ணுமா?
ஓகே சார். Good evening, respected members and distinguished participants. A warm welcome to today's online seminar jointly organized by the Kumbakonam branch, Tiruchirappalli and Madurai branches of the Southern Indian Regional Council of ICAI. To formally commence the proceedings, I kindly request CAG Ganesh, Chairman of the Kumbakonam branch, to deliver the welcome address.
Respected past president of ICAI, CA.R.BHUPATHY sir, CA Vidubhalashathi, Chairperson of Tiruchirappalli branch, CA Satish Kumar, Chairman of Madurai branch, committee members of the respective branches, and my professional colleagues. Good evening to all. At the outset, it gives me an immense pleasure and honor to welcome you all to today's online session, jointly organized by the Kumbakonam, Tiruchirappalli and Madurai branches of the SARC of ICAI. Today, we are truly honored and privileged to have with us a stalwart of our profession, CA.R.BHUPATHY, past president of our esteemed institute, the Institute of Chartered Accountants of India. Sir, your presence itself is a great source of inspiration for all of us. Your leadership shaped our profession, and your knowledge continues to enlighten us. On behalf of all the three branches and the members present here, I extend a most cordial welcome to you and express our deep gratitude for graciously accepting our invitation to share your professional expertise. The topic of today's discussion, re-registration of trust and amendment for the assessment year 2025-26. It is highly relevant in the current regulatory landscape and will provide immense practical insight for our members. I also take this opportunity to thank Tiruchirappalli branch and the Madurai branch for collaborating with us in organizing session. This reflects our shared commitment to continuous learning and professional growth. Before I conclude, I kindly request all the participants to keep your microphone muted during the session and raise your queries only after the session concludes. So once again, I extend a warm welcome to all the participants and look forward to an enriching and insightful session. Thank you.
Thank you, Chairman, sir. I now request the CA Bhaskaran, Vice Chairman of Tiruchirappalli branch, to kindly introduce our distinguished speaker for today's session.
Thank you. Good evening to all esteemed members. On behalf of Kumbakonam and Tiruchirappalli branch of SARC of ICAI, I welcome you all for today's webinar on the topic of re-registration of trust and amendments for the assessment year 2025-26. And it is a great privilege for me to introduce today's speaker, CA.R.BHUPATHY sir. CA.R.BHUPATHY sir had his schooling in Hindu High School, Triplicane, Chennai, completed his commerce graduation from Vivekananda College, Chennai, and a fellow member of the Institute of Chartered Accountants of India. He is the founder partner of CA.R.BHUPATHY & Co. Chartered Accountants, established in 1976, an Indian-based public accounting firm which is into audit, taxation, and consultancy. He served as a resource person in taxation in ICAI, LIBA, and other professional institutions in South India for more than 3 decades. He also served as a chairman of International Fiscal Association, India branch, Southern region of the term 2006 to 8. He served as a member of the Central Council of ICAI for the period of 9 years and occupied the position of President of ICAI for the year 2003 to 4. He was also a member of Education Committee of the International Federation of Accountants and apex body for accountants worldwide for the term 2003 to 6. Recipient of the following awards for his singular contribution to the accounting profession: Tally Apex Lifetime and Legacy Award, July 2025. Paramacharya Award, Certification Award given by Confederation of Asia Pacific Accountants. And also important positions held in the past are Chairman of Geojit Financial Services Limited, Director Geojit Credits Private Limited and Geojit Technologies Limited, Member Central Board of Direct Taxes Advisory Committee CBDT, Board Member Insurance Regulatory Authority of India, Member Study Group constituted by World Bank for Study of Corporate Governance in India, Member National Accounting Standard Committee of Department of Company Affairs, Member Accounting Standards Boards of SEBI, Director ICAI Accounting Research and Foundation for a period of 8 years. With this, let us all give a warm welcome to CA.R.BHUPATHY, sir. Thank you.
Thank you, sir. It is now my privilege to invite our eminent speaker, CA.R.BHUPATHY, past president of ICAI, to take up today's session on re-registration of trust and amendments for assessment year 2025 to 26. Over to you, sir.
Thank you, Rani. Mr. Ganesh, the chairman of Kumbakonam branch, Madam Vidubala Satish, chairman of Tiruchirappalli branch, members from Kumbakonam, Trichy and Madurai branch also have joined. I'm very glad about that. Let me begin by saying a big thank you to CA Bhaskaran for the kind words of introduction he gave about me. Let me also thank Mr. Ganesh and Vidubala Satish for extending an invitation to me to speak on this very important topic, re-registration of trust and the amendments made by the Finance Act 2025. Although the title for today's presentation was given like that, I would like to cover certain aspects of not-for-profit organizations. And incidentally, in the process, covered re-registration of trust and the amendments made by the Finance Act 2025. All of you, chartered accountants, are aware that we as chartered accountants, if we collect some money from our clients towards expenses, there are very strict regulations which says that the money collected from the clients should be kept in a separate bank account, should not mix with our own accounts, should be accountable, and it should be very transparent. All these regulations are there in our code of ethics of the institute. But if you see a not-for-profit organization, whatever amount they collect by voluntary contributions or any income which they get is all public money. So when it becomes public money, the importance of maintenance of accounts, importance of filing returns, and various other compliances becomes very, very significant and important. And any non-compliance, and we as chartered accountants, when we advise our clients, we have to be very careful and vigilant to advise them properly so that they don't commit any mistakes, and which leads to even cancellation of registration or refusal of registration. Therefore, this topic is very, very important. Let me congratulate all the three branches for selecting this topic. It's a very complex topic. I have two methods of explaining any chapter. Whenever I start explaining any chapter, the first method is take the provisions of law, start with the charging provisions, start explaining it to its logical conclusions. Then in the process, we'll be completing all the provisions relating to a particular chapter. The second way of explaining a particular chapter, is to take general observations. What are the requirements in general without reference to section numbers, and explain what are the requirements, what happens if you don't comply with the requirements, what will be the tax, what will be the other consequences, explain that. There are two methods. I would like to follow the second method for a charitable trust or not-for-profit organization. The reason is the sections are dispersed from section 11 to 13 and also section 10 and sections 115 BBI, 115 BBC and 164 of the Income Tax Act. So many sections are there. To explain it by way of provisions in the income tax law, it's rather very difficult and challenging, more particularly in an online mode. So with this background, I would like to now share the screen with you, my presentation, and is the screen visible?
Yes, sir.
Can you confirm whether the screen is visible?
Yes,
Yes,
sir.
sir. It's visible.
Yes, sir.
Okay, we'll go ahead. Now, I have titled it as assessment of why this slideshow is not working. Yes. Let me explain to you the overview of the provisions. What I intend to cover, it's a very ambitious plan of mine to cover many aspects within 90 minutes time. What is it I plan to cover in this session? First one is the registration of NPOs. What are the requirements and what type of questions the department will ask, how to get prepared on it. Second is what are the prohibited transactions? There are certain transactions which a non-profit organization should not do. If they do, what is the consequence? Third is what are the sources of income of the NPO and how it will get taxed in case they don't apply. Fourth is application of income. Fifth is there's a concept of deemed application of income. What is a concept of deemed application of income? I will say. And then accumulation of income for a specific assignment of project. There are specific provisions for it. I will explain those provisions. Finally, the filing of returns and the audit of trust, audit of NPOs. These are the 8 bullet points I intend to cover in this session. Let me see how much we will be able to cover in this session. The first one is regarding the amendments made by the Finance Act 2025 regarding registration of trust. A very small point, but a very important point for the tax practitioner as well as the trust NPOs. Small NPOs, normally the registration is valid only for 5 years. If a registration is granted, it is valid only for 5 years. But for small NPOs, they extended the validity period from 5 years to 10 years. So this leads us to question what is meant by a small NPO. The clarification is given. Small NPOs means total income of the NPO before the exemptions under section 11, 12, 13 exceed 5 crores. A very important point is in each of the 2 previous years preceding the previous years. In each of the 2 previous years preceding previous years, they should be it should be 5 crores or less than 5 crores. If it is exceeding 5 crores, it ceases to be a small NPO and the validity is only for 5 years. So this is a good amendment which they made in the Finance Act 2025. Small NPOs can get a validity of their registration for a period of 10 years. This is also a very significant amendment in Finance Act 2025. Earlier, the law said if the application is not application for registration, if you make an application for registration, is not complete or contains false or incorrect information, if it contains false or incorrect information, the cancellation could be refused or the registration could be refused or cancelled. They could do that. But Finance Act 25, it's a very dangerous clause. Under the existing law, there was a dangerous clause, not complete. Supposing there's a column in the application form which you are not filled up, that means the form is not complete. Because you are not filled up that column, if they're going to refuse registration, it is not correct. Therefore, in the Finance Act 2025, they removed the phraseology, not complete. That phrase has been removed. Therefore, only if it is incomplete or only if it is false or incorrect, they could cancel or refuse registration. Otherwise, they cannot refuse registration. This is also a very significant amendment which you have. Third one, all chartered accountants have to gear up. You know, in 2021, all trusts, all NPOs were mandated by the Income Tax Act to get themselves re-registered. You would have got yourself registered in 1985, 1990, or whatever, whichever year you want. But 2021, they said all of them should get themselves re-registered. And accordingly, most of us have got our trust re-registered in the year 2021. And if it is 2021, then what happens is 5 years validity. So 21 to 26, March 26, all the registrations will lapse, will come to an end. We have to apply for re-registration. And the law provides you have to apply for re-registration within 6 months for registration, within 6 months from the expiry of the registration. So 31st March 26, it expires. So by 30th September 25, you have to file an application for registration. We are now on 26th of July 2025. We have got only 2 months time to get prepared, and you have to apply for fresh registration for all the trusts which you have in your client list. So take an Excel sheet, all the trusts which have been registered in 2021, get prepared for it. And how you should get prepared for it will come in the next few slides, which I'll go a little fast because these are all self-explanatory. Registration of NPO, documents to be kept ready. This will serve as an eye-opener for you. What all things you have to keep ready for making an application for registration. First one, copy of the trust deed, which is very easy, you will have it. KYC of the trustees, office bearers of the trust, and orders of registration of trust and ATG registration. All these things will be there in the permanent file of any trust. Take it, keep it ready. Along with the application, you may have to submit it with the department. Online application you have to submit, but if the commissioner asks for some information, you must provide for all this information. In fact, I have culled out all these details from the notices which we have received for some of our trust from the Commission of Income Tax. These are the information they ask. So I'm sharing it with you so that you could get prepared accordingly. 3 points are rather very simple. You will have all these particulars. But the fourth one, I would like to spend a little time on this. Activities of the trust with reference to clause in section 215. 215 of the Income Tax Act explains charitable purpose, defines charitable, includes relief of the poor, medical relief, education, yoga, preservation of monuments, and any other object of general public utility. Now, what they say is, what are the activities you have carried out during the year, not only during the year, for the preceding 3 years, 3 years, or if the trust has been there only for 2 years or for that period. So what I'm saying is, take all the activities. If they have done some education activities, if you have done some relief for the poor, document it, write a small note on it, keep it ready. And also, nowadays, in the same letter which the commissioner has written, he is asking for photos of the activities taken, videos of the activities taken. So all these things to establish that you are doing real charitable activities if you submit it, the registration process will be expedited, will become faster. So each category, whether education or medical relief or relief of the poor, if you have done some activities. In fact, I could share a personal experience of mine. One of the large companies took up a project of, in their charitable trust, they took up a project of educating the people in the smaller towns, villages, technology, how to teach technology. Instead of asking the people to come to the institution to teach them, very difficult for the students living in some remote corner of India to move to a city to attend a class on information technology. So what they did was they put all the systems in a bus, very nice bus, all the computers, and took the bus to a small village, parked it near the school, and asked the school children to come and into the bus, and they taught them in the bus itself. In other words, it's a good activity, but it was captured by way of a video, captured by a photograph, and a very detailed note as to what they're going to do. So this will help you in your registration process. Trust I'm making things clear for you and you're able to understand. Again, accumulation of income and deemed application of income. I'm not going to spend time on this now, but later on, in the later part of my presentation, I'm going to deal in detail accumulation of income and deemed application. For deemed application, Form 9A. For accumulation, it is Form 10. All of you are aware of this and how complex it is, you know. But only point I would like to tell at this point of time is that whatever figures you give in Form 9A and 10 should correlate with the figures which you are filling in the income tax returns. In the income tax returns and the bank statements also. If you say you applied some funds and in the bank statements there is no application of funds, there will be a problem. So take care to see that accumulation, deemed application, and bank statements and income tax returns, the figures which you give in all these things should match with each other, should relate to each other. If they are divergent, then the chances of you getting re-registration will become difficult. Then attach year-wise list of donations received above 10,000. See, the trust has to collect information from all donors about whatever is the amount. But when you apply for registration, you give the details of only above 10,000 of the donor details, donor and donee bank statements. These are all rather very simple, excepting item 4 and item 5, which requires some explanation. I have explained item 4, but item 5, I will explain it once again when I come to the later part of my presentation. Now, coming to reference to important clauses in the trust deed or in the memorandum or the society's memorandum, whatever is the type of organization. Very often, these clauses are not there, or if it's not there, you should make an amendment in the trust deed to include these clauses. If the trust has been formed recently, you will have all these clauses. If the trust has been formed some time back, possibly these clauses are not there. So take care to see there should be a specific clause in the trust deed that the objects are not for religious or for a particular caste or community, should not be for commercial purposes. Very specifically, there should be a clause. If the clause is not there, insert the clause, amend the trust deed and insert the clause. Benefits should be for the public and not for specific individuals. Very specifically, there should be a clause. These are all important points for drafting the trust deed. If you have not included it, kindly include it. Transfer of assets to other registered NPOs on dissolution. There is a requirement now. In case the registered NPO is going to be dissolved at some point of time, then all the assets of the trust should be transferred to another registered NPO within 12 months. There should be a clause in the deed. Then funds shall be used only for objectives of the trust or the society or the company, whatever it is. And these are compliance with any other law. This is a real problem. Many of the non-profit organizations do not know which are the laws self-applicable. I asked an advocate once, do you know how many legislations are there in our country? We really do not know how many legislations are there in our country. Then all the small trusts have to know which other laws are applicable and they have to comply with those laws. For example, FCRA, of course, only big things, whenever they get foreign contribution, they have to get registered. Otherwise, then if it's a rented premises, no objection certificate from the owner, government permissions, list of legal proceedings, and submit a copy of the latest return filed with the registrar of something. I'm not taking time on all these things. I'm just listing it out for the purpose of your record, so that, you know, if you go through this, you will know what all is required for applying for registration. Income tax requirements. Now you see the first point here. Attach certified copies of audited financial statements and details of order passed earlier where it was rejected. If you have made an application for registration and it is rejected, why it was rejected? They are asking that. Attach a copy if any. Now they are writing only audited financial statements. They have not said audit report. Now the question, some people are asking me the question, only audited financial audit report need not be given? No. Once they say audited financial statements, audited financial also includes the audit report. You have to submit along with the audit report to the commissioner to decide whether to give registration or not. State whether any business undertaking is held. See, if the trust is having any business undertaking, I will tell more about this business undertaking later also. You must give certified accounts of an audit report under 44AB of that business. That is very important for registering, for renewal of the registration. All these documents are required. File undertaking that no infringement of first proviso to 215. What's the first proviso? First proviso is if the trust is carrying on any other activity of general public utility, then it should not indulge in any business. It can indulge in a business which is incidental to the objects, but the gross receipts from that business should not exceed 20% of the total gross. This is, it should not infringe. You should do an undertaking. Yes, I have not infringed that provision. This is what they are asking for. And it's not given for benefit of any specified person because Act provides you cannot give a benefit to a specified person. If you give a benefit to a specified person, then that more benefit which is given is charged to tax. Then you should give an undertaking, that declaration that it is not given for any specified person. These are requirements. Now onwards, I have got something very important to say. I will now go into the 4 categories of prohibited transactions. What are these 4 categories? Because the consequences of these 4 categories of prohibited transactions are different. One list of prohibited transactions says the registration could be refused, registration could be cancelled, and if the registration is cancelled or refused, it will lead to levy of tax on accredited income. 115 TD will be triggered. That is one set of violations. Second set of violations where the flat rate of 30% tax under 115 BBI will apply. Third list of violations where the maximum marginal rate under 164(2) will apply. Fourth type of situations, if you receive anonymous donations exceeding a particular amount under 115 BBC, 30% tax will apply. So 4 different categories. I'm going to take time. I'm going to take time to explain this aspect in great detail. Kindly bear with me. You all know it's a complex chapter, so it requires an effort to really listen also. I would always like to say, of the 2 things which we are doing, I am speaking and you are listening. You are doing the more difficult job. I am doing an easier job of talking. You are doing so. You have to take efforts to listen. So kindly go through this and you will definitely find it informative and useful. What are these specified violations? Specified violations which leads to cancellation or refusal of registration. What are these one? First one, if the amount of income which is applied other than the objectives of the trust, if it is the objects of the trust is listed out A, B, C. If you are not going to apply for the objectives of the trust, you apply it for some other purpose, then whatever registration they have given, they could cancel it, or when you go for renewal, they could refuse. So this is a very important point. See that the amount is applied only for the objectives of the trust. Second, business income, business not incidental to the objectives. Incidental, if it is incidental, it's okay, it's permitted. But if it is not incidental, it's not permitted. Okay? And even if the business is incidental, what is the other requirement? The other requirement is for that particular business, separate books of accounts should be maintained. And if no separate books of accounts are maintained for that business which is incidental to the objectives, then what will happen is it will say specified violation leading to cancellation or refusal or registration. Once it is cancelled or refused, accredited income will get triggered. So this is again a very, if you are carrying on some business which is related to the incidental to the objectives, fine. If it is not incidental, straight away you are out. You will not get registration. If it is incidental, another requirement is that you should maintain separate books of account in respect of the business. And next, application of income to private religious purposes. If you are going to religious purposes, it is not allowed. Application for benefit of a particular caste or communities. This is also a specified violation. Activity carried out is not genuine or not in accordance with the condition of registration. In other words, they have given you certain conditions at the time of registration and you don't comply with the condition. Then also they will refuse or cancel registration. If not complied with the provisions of any other law. This is what is becoming very important. Each NPO should know what are the other laws applicable. For example, if they are having an eatery as a related business incidental to the objects of the canteen, Food Act may apply, Fire Act may apply, Employees Act may apply. All these laws they should comply. If they don't comply, then there is a problem. Right? Provide false or incorrect information in the application for registration. Now these items, all these specified violations will lead to cancellation or refusal of registration. This is what the commissioner would like to see at the time of granting re-registration. What type of activities you have carried on and whether you conducted any specified violations or not is something which the commissioner would like to check. Very important point. So don't allow this to happen to any NPO. If you allow this to happen, then accredited income will come, net assets will be calculated, 30% of the net assets will be asked to pay tax, all sorts of complications will come. Now, second set of prohibited transactions, where 115 BBI will apply, where the income is taxed under 115 BBI. What are the transactions? One, accumulation in excess of 15%. All of you know that 85% of the income should be applied for the objects of the NPO. If you are not applying 85% and you are accumulating more than 15%, that excess amount which you are accumulating will be chargeable to tax under 115 BBI at the maximum order at the 30%. Now we come to this deemed application not applied within specified time. I'm going to reduce my C. I'm going to change the voice modulate my voice, and I'm going to explain this in detail. You all know Section 11 and the explanations under Section 11. if an NPO is unable to spend 85% for the following two reasons, it shall be deemed to have applied it for the objects. So what is that? The first one, the reason for not applying the income, explanation to section 11 provides non-receipt of income. What's that non-receipt of income? Trust follows the accrual system accounting, and it has got some deposits in a bank. Interest accrues on the bank. Now what happens? Interest has accrued, it is accounted as income, but it is unable to spend because it has not received. Therefore, first exception is non-receipt of income. Second exception, best exception, they simply put an omnibus clause for any other reason. For any other reason, if you are not able to apply. What is that any other reason? Example for that would be, if you receive a substantial amount in the fag end of the year, say last week of March, you receive 1 crore as voluntary contribution. You have to spend 85% of 1 crore within 1 week time for charitable purpose, for the objects of the trust. Very difficult to spend. So in such cases, any other, this also is very important. These two reasons. But what I want to explain is, if you fall under the first exception, that is, if you fall under the first exception, what is that? Non-receipt of income. That amount which is deemed as application has to be applied in the year of receipt. Very carefully listen. It has to be applied in the year of receipt or in the immediately succeeding previous year. Whatever is the deemed application for non-receipt of income, it has to be applied in the year of receipt or in the immediately succeeding the previous year in the year of receipt. After we receive the immediately succeeding. And if it is deemed to have been applied for any other reason, it should be applied in the next financial year itself. Next previous year itself, it has to be applied. So this is very clearly spelled out in the section which you have to have in mind. Because when you're filling up that form 9A and for the deemed application of income, you have to be careful about this. So what is deemed application? And if it is not applied within the specified time, that amount which is not applied within the specified time will be charged to tax under 115 BBI at 30%. So you must keep track of the deemed application and see that you spend it within the specified time. If you don't spend it within the specified time, this is the consequence. Application other than the objects for which it is accumulated. So one is deemed application. The second one is known as accumulation of income. This is given in 11(2) of the Income Tax Act. 11 subsection 2 of the Income Tax Act. I'll give you one small example. If an NPO is planning to construct a hospital for the weaker sections of the society, it's planning to construct an hospital for the weaker sections of society, which is charitable, and it is objects is for medical relief. If they are going to accumulate at the rate of 15% per annum, they cannot complete this project at all. Therefore, the NPO could make an application to the assessing officer in the prescribed form 10, seeking permission to accumulate more than 15% for the specific project of constructing a hospital. They could make an application. The officer will give you the permission based on merits of your case. Only two conditions are there. Two conditions. Condition number one, the project should be completed within 5 years. You can accumulate the income only for 5 years. And second, it should be invested only in specified investments. Whatever you accumulate should be invested only in specified investments. If it is not invested, then also there is a consequence. And third point I would like to mention on accumulation of income. Supposing the officer has given you 5 years time and you applied for a hospital, officer has given permission for hospital, everything is done correctly. But after 1 year, you find that you want to change from hospital to some other activity. Now you want to construct a school. You are having both medical relief as well as education. So you want to construct a school. Now, if you go apply to the officer, can you apply to the officer for change from hospital to school? Answer is yes. You could apply to the officer asking him to change from hospital to school, and the officer will have to consider the application on merits. So 3 points are there. One is it cannot be accumulated for more than 5 years. It should be invested only in specified investments, modes of investment. And third, you could change the object if required with the permission of the officer. And if the amount so accumulated is used for other than the objective for which it is accumulated, it is accumulated for school, but you spend it for something else without permission, then 115 BBI will get triggered and they will apply tax at 30%. So application other than the objects for which income is accumulated. Next, accumulated amount not invested in specified investment. I told you this accumulated amount, which you are going to accumulate more than 15%, should be invested only in specified modes of investment which are listed out. You must invest there only. If you are not invested, then this 115 BBI will. Amount credited or paid out of income accumulated for specific credit or paid out of income accumulated for specific purpose to any registered arm. Okay. I would like to explain this part of it. You are aware that application of income will include if I contribute out of the current year income, if I contribute to another registered NPO, whatever I contribute to another registered NPO, 85% of the amount which I contribute will be considered as an application. Okay? Am I clear on this particular point? I have NPO. I got some income during the current year. Out of that income, I am not able to spend for charitable activities. I contribute to another registered NPO. It is considered as an application. But if I give 1 crore, 1 crore is not considered as an application. 85% of 1 crore, 85 lakhs only will be considered as an application. But if you are going to pay out of the income accumulated, whatever income accumulated for a specific purpose, if you are making payment out of such income, the accumulated income to another registered NPO, that will not be considered as an application. Okay? Amount credited or paid out of income accumulated for specific purpose to another registered NPO. Then which section will get triggered? In all these 5 situations, 115 BBI will get triggered and taxed at 30%. So earlier set of specific prohibited transactions, it will trigger refusal or cancellation of registration, leading to levy of accredited tax on accredited income. This set of 5 will attract tax at 30%, flat rate of 30% under 115 BBI, which is also a very serious implication. And we come to the third set of prohibited transactions. Accredited income, refusal, I told you, cancellation of registration or failure to apply for registration. Then second one, conversion or merger with other entities not eligible for registration. Convert your registered association into another registration which is not eligible for registration. Then also accredited income will get triggered and fails to transfer all its assets within 12 months from the end of the month in which dissolution takes place. You remember I told you when you apply for registration, you have to give a clause in the deed saying that all assets will be transferred in the event of dissolution. the assets will be transferred to another NPO, registered NPO, within 12 months. If you don't do that within 12 months, accredited income will get taken. So, in 3 situations, accredited income, how the accredited income, that's a separate topic. We take the assets minus the liabilities. On that, you pay tax at the maximum point. It's a huge amount. So, lesser number of cases we handle under accredited income, it's a good indication of our performance of audit. Because we don't allow our NPOs to get into this. So, this is this prohibited transactions. It's taxable at maximum marginal rate. Now, you may ask me a question. What exactly is the difference between taxing under 115 BBI at 30% and taxable under 115 DD as maximum marginal rate? The difference. Once you go under 115 BBI, it is only tax rate plus cess, but surcharge is not available. But if you come under maximum marginal rate, the maximum marginal rate is defined in Section 2 of the Income Tax Act, which includes the surcharge also. So maximum rate plus surcharge plus cess, everything will come. So between the two violations, this is more serious because the tax implications is much higher. The third situation is taxability under 164(2). Now, please be careful. Investments in other than eligible modes. If a trust is going to, or NPO is going to invest in other than eligible modes, the list of eligible modes are there. If they don't invest in those securities, they invest elsewhere, or if benefit is given to a specified person, they give a big list of specified persons. If benefit is given to a specified person, then what will happen is taxability at maximum marginal rate, provision to proviso to Section 160. This is what. Okay. In addition to this, there is anonymous donation, which will come a little later. But you will all ask me a question. Sir, under 164, there is also a provision which says that tax will be levied at the rates applicable to AOP. These two income, investments other than eligible modes and benefit to specified person will be chargeable to tax at maximum marginal rate under 164(2). Proviso. But if you have an income from 85% of the income is not applied, I'll give you one small example. The income of somebody is writing it. The income of a registered NPO is 1 crore. They have to spend 85%. They have spent only 70%. So 70 lakhs they have spent. They ought to have spent 85 lakhs. They spent only 70 lakhs. So 85 minus 70, 15 lakhs will be chargeable to tax at the rates applicable to an AOP, slab rates. That is one thing. Similarly, there's another very important point which sometimes goes unnoticed. Ganesh, somebody is writing on the screen. Some red line is coming in. You are able to see the red line?
Yes, sir, we are seeing. Anybody is.
Okay, it doesn't matter. Okay.
Samsung SM.
Can you use the eraser and take it out? Okay, doesn't matter.
Sir, you please continue, sir. I will ask the people.
Okay. If it's I'll give you another example for this. A minute point which I'm trying to explain is that a not-for-profit organization registered not-for-profit organization is coming under any other object of general public utility. Coming under any other object of general public utility. And it is carrying on a business which is incidental to the objects. Example I could give you, it's a sports association. It wants to develop the sports talent of the people living in a village. Definitely it's a charitable activity. It is not coming under education. It's not coming under medical relief. It is not coming under renovation. It's not coming under yoga, but it's coming under any other object of general public utility. It is carrying on a business incidental to the general public utility. Now, if it carries on a business incidental, the gross receipts from that business, should not exceed 20% of the total receipts of the NPO. That's the proviso to section 215 of the income tax. If it exceeds, that income will be chargeable to tax. Now, once you say it is chargeable to tax, at what rates it will be chargeable? That's the question. This one, which I am now explaining, is not coming under specified violations which triggers cancellation or refusal or release. It's not coming under 115 BPI. It's not coming under accredited income. It's not coming under 164.2 also. The proviso to 164.2. Then where will this income be charged to tax? Again, I will explain it. It's an NPO carrying on an activity of any other activity of general public utility. Example, sports association or sports institute. Now it is carrying on a business. The requirement is the receipts from that business should not exceed 20% of the total receipts of the NPO. It exceeds. If it exceeds, means that business income will be charged to tax. If it is chargeable to tax, then at what rates? Now it comes under section 164.2, main section, which will be chargeable to tax at the rates applicable to AOP. It's not chargeable to tax at the maximum market rates. It's rates chargeable to tax at the applicable to AOP. So this is one more aspect. The other aspect of business income which I have to explain is, trust coming under education, not under any other object of it, coming under education, medical relief and all, can carry on a business which is incidental to the objects. And it should maintain separate books for that. That I explained to you. But they have to file a return. They have to compute the business income as per the provisions of the chapter profits and gains of business or profession. That business income will be subject to tax audit if the limits exceed the everything. They have to do it. And if you see that 11.4 of the Income Tax Act, it says that if you compute your business income and disclose that business income, the not-for-profit organization return, and if at the time of assessment, the officer makes certain disallowances, you have claimed some expenditure, or you are not complied with 40A3, cross checks or account pay checks, he disallows and increases the income. That additional incremental income which he makes will not be considered as an application for the objects of interest, will not be considered as an application for charity. That is also a point which you have to take note of. And if that is done, it is chargeable to tax under which category is something which we have to ponder upon. I'm not, my view is it will come under AOP at the rates applicable to AOP because there is no specific provision for that. But if you carry on a business which is not incidental to the objects, then straight away your registration will get cancelled. So the list of prohibited transactions, I told you there are 4 categories. I've explained 3 categories now. One is cancellation. Second is 115 BBI. Third one is taxability under section 164(2). 2 aspects there under 162. One is the maximum marginal rate, and second, certain types of income which will be taxed at the rates applicable to AOP. Now, the other aspect is anonymous donation. Anonymous donation, what does it say? I'll go to the next slide. Source of income. I'll come to anonymous donation straight away. 115 BC. Anonymous donation, if the anonymous donation exceeds 5% or rupees 1 lakhs, whichever is higher, then it will be chargeable to tax at 30% under 115 BBC. This is another section. So you have to be careful about that. Now, coming to the source of income, I think I've explained to you the 4 categories under which NPO could be taxed at different rates. One is the cancellation of registration. 2 is it will be treated as 150 BBI 30%, 164(2) maximum marginal rate, and in 164(2) rates applicable to AOP, and the anonymous donation 115 BBC. If it exceeds 5% or 1 lakh, whichever is higher, then it will be charged to tax at the flat rate of 30%. These are some of the things which you have to note regarding. Now, coming to the next point which I have, interest and rent. These are the source of income. I would like to explain what is deemed corpus donation. I do not know whether you come across this. It is not a very frequently visited provision, but still, since we are doing a session like this, I wanted to cover what is the deemed corpus donation. It is applicable only to a NPO which is having, which is owning a temple, church, gurdwara, or any place of worship, and it receives contribution for renovation of the temple, church, gurdwara, or place of worship, mosque or place of worship. Then the NPO has got the option to treat that amount as a corpus donation. Once it is treated as corpus donation, it is not taken as income and charged to tax. So you've got the option to treat it as corpus donation, provided you own, the trust owns a temple, church, mosque, gurdwara, or any other place of worship, and contribution are received for renovation. The NPO has got the option to treat it as a corpus contribution, and it should be applied for the specific purpose of renovation, should be invested only in specified investments, and should not be given as a benefit to any other person. So these are some of the questions, points which you have to note. Supposing you violate these conditions, subsequent year you use it for something else, then in the year of violation, it will be treated as income and charged to tax. So these are the points which you have to remember. Now coming to section 215, and this is what I explained to you, preservation advancement of. Now here only there is a proviso which says that it should not exceed 20% of the gross revenue. One thing which I am not venturing to tell you, what is education? What is education? Even in the recent times in the newspaper, so many items have come. Education, one narrow view of education is that it is only education imparted in schools, colleges, classrooms. Whereas overall, there are people who say even traveling is education. There are people who say making people employable. They have finished the college, they are not ready for employment. They give them some training to get employable. Then also that is also education. But there's a lot of confusion there. I'm not going to that aspect, which will take a long time to explain. Now, coming to business not related to the object of the trust, prohibited. Business related to the object of maintenance of books. Here only I mentioned additions made to income return at the time of assessment will not be considered as an application for the objects. Hope I'm making myself clear on that. Yes, this I've explained. I've explained to you. I need not come back. Connected with the advancement object, gross receipts restricted to 20% of total gross receipts. Now we come to application of income. This is also another important area which we have to be careful about. Let me take some time, another 10 minutes on this aspect, then we could go to the forms. Application of income. It should be applied for the objectives of the trust. Now, very important here. If you have received some corpus donation means a donation which is received with a specific direction. And if you are making an application out of that corpus donation, that will not be considered as an application. That will not be considered as an application. For the purpose of calculating 85% of the income is applied for the objectives of the trust, any amount contributed from the corpus donation will not be considered. Act is very clear. However, they made in the same provision saying that if you are made out of corpus donation and within the period of 5 years, 5 years from the end of the year in which the amount was spent out of the corpus donation, it is brought back as a corpus amount and put in specified investments. Then, in the year in which it is brought back, it will be treated as an application of income in that year. I'll repeat this point once again. NPO has received a corpus donation of 10 crores. After 10 crores, 8 crores it is used for a charitable activity, objects of the trust. This will not be considered as an application. However, within 5 years, if the NPO is to collect the money from various sources and replenishes the corpus amount back by 8 crores or whatever amount, provided it is done within 5 years, in the year in which it is replenished, it will be treated as an application of income and the provisions will be calculated accordingly. This very specifically, it is provided in section 11 of the Income Tax Act. We have to go through the relevant section to understand this. Earlier, if it is made out of corpus, it was not eligible. Now they added this, replenishment will be eligible. Because corpus contribution is not chargeable to tax. So if you make a application out of corpus contribution, it will not be considered as an application. So this is what is very good. Application made out of loan and on repayment. Similar treatment. To take a loan and apply it for the objects of the trust, it is not considered as an application. If you take a loan and make an application, it's not considered. However, if the loan is repaid within a period of 5 years, it will be treated as an application in the year of repayment. In the year of repayment, it will be treated as an application. That is very clearly specified in the Act. Application made from capital gains. Now here I would like to spend some time the capital gain part of it. I do not know how many of you have come across this particular situation, but it provides an interesting reading. Just give me a 1 minute time. I will take the relevant portion. The relevant section for capital gains is 11(1)(a). 11(1)(a) of the. Let me tell you that 11(1)(a) was introduced in the Act by the Finance Act 1970. If an NPO is going to have a capital asset, let's say a land or a building, and the NPO transfers the land or the capital asset, makes a capital gain. Okay? And during the year, it invests in another capital asset. The capital gain gets exempted. 11(1)(a) provides for it. I'm not going to the detailed calculation of capital gain, but the exemption is available. But this provision was introduced only in 1970. So trusts which have transferred the asset prior to 70, the question arose whether the capital gain will be chargeable to tax if it is plowed back in another capital asset. Maybe it may be useful for all of you. I draw your attention to circular number 2P. I have not put in the slide, so I'm giving it now. Circular 2P LXS 5 dated 15/5/63. 63, old one. Not very relevant for us. Law provides, the circular states that this capital gain exemption can be claimed even if the asset is transferred before 70. Even if the asset is transferred before 70, you can claim the exemption. Then 70, this provision came. Now, the question arose, now that there's a provision in 70, what happened to the transactions done before 70? How can that circular apply? They issued another circular saying that even after the amendment in Finance Act 70, whenever the capital asset is transferred, you could get the exemption if the net consideration on the sale of the asset is invested in another capital asset during the year. Fair enough. But sometimes it is not possible for an NPO to sell an asset and invest in another capital asset within the year itself. Very difficult. If you want to sell an asset and do it during the year itself, very difficult. Many trusts had some problems. Therefore, this matter went up to the Calcutta High Court. And the Calcutta High Court held that till such time you invest in another capital asset, you could keep the money in fixed deposits in bank. And that is sufficient compliance of law, and the benefits cannot be denied. This Calcutta High Court case, I got the reference. It could be parked in. Now, I will come to it a little later in the direct income tax bill. There are some amendments in this regard. So the application of income, these points I wanted to tell. The application should be made for the objective trust. If you make it out of corpus, it's not allowed as an application. However, if the corpus is replenished within 5 years, it is considered as application in the year of replenishment. Application made out of loan is not considered as an application. However, if the loan is repaid within 5 years, in the year of repayment, it is considered as an application. Reinvestment of sale proceeds of capital assets in another capital asset, and till such time it is invested, parking in fixed deposit is permitted. This is a quick summation of all the 4 points which I just now mentioned. Now, coming to deemed application, I've told you this, I've explained to you this. Non-recurring income shall be deemed to be the income of the year in any other reason to be spent in. This is very important. Shall be deemed to be income the year of receipt or in the immediately succeeding previous year, or any other reason to be spent in the subsequent previous year. This is given in section 11(1) of deemed application. Now, very important point. Form 9A. We are now on 26th of July. As per the existing law, if you want to set aside some money as a deemed application, it has to be filed 2 months prior to the due date for filing of return. So due date for filing of return is 30th September. 2 months prior is 31st July. 26th July today. Those of you who want to claim the deemed application for this year, for March 25, you have to make an application before 31st July, 2 months prior. And in 9A, I got the format of the 9A, I will explain to you. It says that how much is the amount you are treating as deemed application, and for what reason you are telling it for non-receipt or for any other reason. And similarly, from the earlier year, if you had brought forward something, whether you applied it, all these questions are answers for questions are captured in 9A. I got the format of 9A. Time permitting, I will explain that also. So this is the deemed application of income, which is there in 11. One more thing I will tell right now, I will explain it once again when I come later. In the new tax bill, new income tax bill, which is to come from the next year onwards, this concept of deemed application has been withdrawn. All these confusion of filing 9A and all from the next year onwards is not applicable. If the new bill is passed, the new bill is presently before the parliament. If the new bill is passed, then the concept of deemed application of income is sought to be withdrawn. Okay. Whatever is changes in the bullet points I have captured in my last slide, I will explain to you. So this is the filing of 9A is very important. How you have to fill up the 9A also, I will come shortly from now. Yes, this I already explained to you. I need not non-receipt in the year of receipt or immediately succeeding previous year. Any other reason in the immediately succeeding year. See, maybe some of the points which I am telling is repeating, but still it will cement your ideas. Deemed application amount of income contributed as corpus to another registered NPO will not be considered as an application. This is very important. Okay. See, deemed application, if it is contributed as a general contribution to another NPO, registered NPO, it's okay. But deemed application amount, if it is contributed as a corpus, kindly underline this expression, corpus, is contributed as a corpus to another registered NPO will not be considered as an application. So, out of the deemed application, if you are not able to spend yourself, you could contribute to another NPO, but entire amount will not be eligible. 85% of what you contribute will be eligible. But if you say it is going towards the corpus of the NPO, it is not considered as an application. Hope I'm making myself very clear on this point, because these are all small issues which sometimes in our regular work we don't give attention to. I'm highlighting this point. Deemed application amount of income contributed as corpus to another registered NPO will not be considered as an application. 11.2 I have already explained to you. Maximum 5 years, change of permission. Form 10. Form 10 also. Form 10 is relatively easier than and the written form, but Form 9A is complex. That's why they sought to remove it. So this also has to be done before 31st July. So now you got some homework. All the trusts in your list of clients, take them tomorrow itself. Tomorrow is Sunday, 27th July, 27, 28, 29, 30th, 4 days. And if they have some deemed application, you have to file Form 9A. If they want to accumulate that income, you have to file Form 10. All these things has to be done before. Okay. So this is very important, immediate target for you. Now, ITR 7. ITR 7. Whatever you are given in Form 9A and whatever you are giving in Schedule D of ITR 7 should match. See, in audit, they will tell 4I concept. What's that 4I concept? Checker and preparer and checker. Maker, checker. Maker, checker. But as far as the filling of ITR 7 is concerned, I would like to introduce you to 6I concept. What's a 6I? 3 people should have. The person who's maker, checker, and reviewer. Because due to any reason, if this ITR 7 is not filled up properly, the computation of income is auto-populated. If you don't fill up this form correctly, the income gets automatically computed by the income tax department portal. And afterwards, for you to correct it is difficult. Why I'm saying this is, take care to see that the ITR 7 is prepared or filled up properly. If it is not filled up properly, automatic consequences will come. You cannot stop it. So whatever details you give in 9A should tally with what is given in Schedule D of the ITR 7. Similarly, whatever details you give in Form 7 should tally with Schedule I in ITR 7. Okay? Take care. Take Form 10, match it with Schedule I. Take Form 9A, match it with Schedule D. Ask the maker to do it that way. Ask the reviewer to check it that way. Ask the checker to check it that way. And the reviewer also should review it, whether it is done properly. Then, Schedule A is amount applied to stated objects of the trust institution during the previous year from all sources. How you applied this money? That is given in Schedule A in ITR 7. And what are the sources for it? From all sources. What are the sources? You have to tell. Application out of deemed application, accumulated income to match amount furnished in 9A and 10. That's what I'm saying. It's reconciled. So this is very, very important. Filling up ITR 7 to my mind is very crucial, very challenging assignment. You see that it is done properly. It is not done properly. Automatically, you see the next one. Voluntary contribution to be matched with 10BD. 10BD is another form. You remember that the charitable trust has to give details of the voluntary contribution received in Form 10BD. And whatever voluntary contributions we are giving in 10BD should match with what is there in Schedule BC in the ITR 7. So this matching thing, you cannot say one thing in one form and another thing. If there's a mismatch, it will trigger inquiry into your return. Schedule, these two will get auto-populated. Schedule 115 BBI specified income and statement of total income and tax liability will get auto-populated. Once you fill up Schedule D, Schedule I, Schedule A, automatically the return gets auto-populated. And it is at that stage only you have to be very careful so that you could avoid any additions to your income. Now, this is 9A. When you see this 9A, in the first column, they say year in which income is deemed to be applied. In fact, I did not have that facility. I think technology helps us to key in these figures here. I have not done that. If I could key in the figures, it could be easily explained. Year in which income is deemed to be applied, amount deemed to be applied during the previous year of the okay? Say, assuming and for reason, either it is for non-receipt of income or for any other reason, okay? How much has been claimed as an application, okay? And how much was taxed in the earlier years? All these things are there and they're giving the columns for me. So I have a figure which I have done for my exercise, but it will be difficult for me to explain in this fashion. So this form has to be filled up. In fact, I could, if you have the patience, I should tell you also, in case you are able to put the columns and note down this, you can definitely add value to it. If you take the column number one, there 2021, financial year 2021, I have amount deemed to be applied during the previous year is 10 lakhs, assuming it is 10 lakhs. Okay. And the reason is non-receipt of income. See, if it is for any other reason, it's not a problem because it has to be spent in the next year itself. The problem arises in respect of non-receipt of income. If you have not received it, then how to do it? Part of it may come here, deemed application. Part of it will come next year. Part of it may be disallowed. So this filling up of these forms becomes a little complex. See, non-receipt of income. And next two columns will be blank. This is for the financial year 2021. Now I told you financial year 2021, if you have received some money, if you have shown some income which is not received, then you should spend it in the immediately succeeding previous year, in the year of receipt, or in the immediately succeeding previous year of the year of receipt. So 24-25, 23-24, I have spent 4 lakhs out of 10 lakhs. I have spent 4 lakhs. So deemed here I put 4 lakhs because amount deemed application, claimed amount required to be applied. Okay, 4 lakhs. Amount taxed is 2 lakhs. That means I have not applied it at all during that year. So what happens is 2 lakhs. So 6 lakhs goes on. Balance 4 lakhs is there, out of which I spent the current year 1 lakh, 24-25 I spent 1 lakh. So 3 lakhs will be charged tax. It is equal to 6 point. So if you just follow these things, you will get the answer. But it requires some careful study and filling up of this form, which is very crucial. Take time to understand this and do it. But Form 10 is not so difficult. You can definitely understand Form 10 if you simply follow these instructions given in the columns. 11 is equal to 7 minus 8 minus 9 is 10. Automatically you get it. 10 is not difficult. But 9A is rather difficult. Audit of trust I will skip for the moment, and I will straight away go into the special points. Because another 5-8 minutes time we have got. So I'll go to the special points. Very important point. Therefore, I'm skipping the audit part of it and coming. Method of accounting. Now, what method of accounting an NPO has to follow? Now we have a technical guide on accounting for NPOs. It was published in 2022. Wherein they very clearly said in the technical guide that all NPOs have to follow the accrual system of accounting. Accrual system, no cash basis. Of course, it's only a technical guide. We could go and deviate from the technical guide for good reasons. You could say like that. And then they brought in the guidance note on financial statements of non-corporate entities by ICAI in August 23, 2 years back. And in this guidance note on financial statement for non-corporate entities, they said an NPO also is a non-corporate entity. NPO also is a non-corporate entity, and they given the format of the accounting. What type of format you have to give in the guidance note? They given the format of accounting for NPO. And they also said accrual system has to be up. So what happens here? NPO has to necessarily follow accrual system of accounting. And secondly, they have to prepare the statement as per the guidance note. And that statement, preparation of finance statements, is rather very complex. And some of the NPOs will find it difficult to prepare the accounts as per the statement given in the non-corporate entities guidance note. Fortunately for us, you see FAQs on guidance note on non-corporate entity. July 8, 2025. I am telling you to you on 26th July. July 8, 2025 FAQs. They are saying that the format of the accounting for NPOs need not go by the guidance note on non-corporate entities, but you can follow whatever guidance is given on the technical guide for NPOs. Since there is a specific guidance for NPOs, go by that format. And this is, if you read question number 2 and 6, very specifically in the FAQs, frequently asked questions on guidance note on non-corporate entities as late as 8th July 20. The difficulty is this guidance note was issued in August 23. So for the year ended March 24, people have followed the new format. Here in March 25 also, some of them have started preparing. But as late as July 8, 2025, we got a FAQ saying that you forget about the format given in the guidance note of non-corporate entities. Go as per what is applicable to NPOs. It's good. At least now it has come. So we have to take it that way. So these are the two special points I wanted to clarify. Guidance note on non-corporate will not apply to NPOs. The guidance note on non-corporate will not apply to NPOs. So this is what. Now, I will tell these amendments and close with this. And afterwards, if there are any specific questions, I would like to take that. First amendment in the income tax bill 2025, which if the bill is passed, now I think it is before this parliament, already placed before the parliament. In all probabilities, it will be passed. If it is passed, it is coming into force from 1st April 25 onwards. For the year ended March 26, it will apply. Therefore, I am telling medical and education institutions financed wholly or partly by government to be registered. Earlier, it was not required to be registered under the income tax law. But going forward, all these medical colleges and education institutions, medical hospitals and education institutions should get them registered under the income tax law. Whatever registration process I explained will be applicable to them also. Any modification trustee need to be re-registered. Now, under the existing law, only if the modification does not conform to the objects, does not qualify as a object eligible for exemption, then only you should go and only the objects clause is changed, you have to go. But here, any modification in the trustee, you have to go for re-registration. That is the second amendment. The organization, this is very, very important. I thought I should share this with you. You all know that all the old trusts which were registered before 21 had to get themselves re-registered on 1/4/2021. And we all did this. And they gave some time for re-registration and they kept on extending that time. Ultimately, the last deadline also is over. Still, there are a few trusts which have been created before 21 which have not applied for registration. What are they to do? Now, fortunately for us, in the income tax bill, a new window is opened. That those type of institutions which have not applied for registration can approach the Principal Commissioner of Income Tax to condone the delay and get them registered. So this is a very important process which you could think of. Once the bill is passed, this will become contribution to another registered NPO out of the income, 85%. Okay. See, the question of deemed application has been withdrawn. I told you, deemed application of income has been withdrawn. That 9A concept and all is gone. Because the deemed application is if you contribute out of the deemed application of income, earlier 85% was allowed, but now it will not be considered as an application because the entire concept of deemed application has been withdrawn. This is a serious consequence because NPOs may be required to pay some tax, but the confusion of filing Form 9A and the difficulty of filing Form 9A goes away with that. But there will be an outflow of tax for the trust. And accumulation of income, Form 10, under the present law, it has to be filed 2 months prior to the due date for filing a return. But under the new bill, it has to be filed before the due date for filing of return. Capital gain exemption is omitted. 11(1)(a), I told you, if you invest in another capital asset, it's treated as an application. That exemption is being withdrawn. But don't worry, you are not going to be affected because in the new bill, the definition of application of income has been amended to say that if the amount is applied to purchase of incurring capital expenditure also is considered as an application and you can get the benefit. So these are the significant amendments in the income tax bill relating to NPOs. And last amendment, which I have not put in the slide, which I noted down later on. Amendment regarding anonymous donation. Anonymous donation. Please be careful. I'm drawing your attention to this particular point at the fag end of the session. You have to tone up your listening potential and listen to this very important point. Under the existing law, anonymous donations, if a trust NPO is carrying on charitable and religious activities, okay, anonymous donations is permitted, it's not taxed. If it is, unless these anonymous donation is received for a university, college, education institution, medical institution, or hospital. If NPO is carrying on charitable or religious activities, if it receives NPO, anonymous donation, it is not chargeable to tax unless it is collected for a university, college, education institution, medical institution, or hospital. But in the new bill, if a charitable or religious institution is going to collect any anonymous donation exceeding 5% or 1 lakh, whichever is higher, then it will be taxed under 115 PPC at the maximum marginal rate. Only religious institution getting anonymous donations will get exempted. So this is another very important point which I wanted to share. If you see, I should say a big thank you to Kumbakonam, Tirchi, Madurai branch people. We have started exactly at 5:30 and now it's 7 o'clock. In 90 minutes time, whatever was possible from my side in a very capsule form, in a presentation like this, I know there are gaps. If only we had a physical presentation, we could have done a much better explanation for all the questions. So let me conclude my presentation with this, and I will see the chat box. If there are any specific questions I could, or if anyone wants to ask questions, you could ask. Thank you, Ganesh. Thank you, Vidya Bala Satish. Vidhu Bala Satish.
Thank you,
Thank
sir.
you very much.
Thank you, sir, for your enlightening session and sharing valuable insights. Sir, if the time permits, can I read the comments of these questions?
What's that? What is it you're telling?
Can I read the comments from the session?
Yes, yes. Whether public registers would come under any other order.
நீ படிமா.
Okay, sir.
I will
sir.
take Sundar Babu's question. Re-registration order dated in March 22. It is valid for a period of 5 years, 23, 24, 25, 26, 27. Okay. Say valid up to 26, 27. When to apply for registration? Okay. Assessment year to be extracted to financial year or the time the file is received. He himself has said safely apply for 25 years. That is the best thing to do, safely apply for 25. But I personally feel if you go for next year also, it is within because the validity, they are given a particular date. Till that date, it is valid. So next year also you could apply. But to be on the safe side, if you want to avoid anything, let you apply. And if they say, no, you can come next year, you can come next year. That would be a safer approach. But to my mind, my answer to your question is, if you file it next year also, 26, 27 also, it will be okay. There is no restriction. And you are not a small NPO. If you are a small NPO, automatically it is for 10 years. This year will not apply. What's your total income before the exemption? If it is less than 5 crores or 2 crores or 5 crores, I said 5 crores, then validity is for 10 years.
Hello, sir.
The application of yes.
Hello.
Yes.
Can you talk, sir?
Pardon?
Can you talk? If it is a
Yes,
small,
yes, please. Sundar
small
Babu.
MP, Sundar Babu, sir. How are you, sir?
Yes. Yeah, I'm fine,
Sir,
Sundar Babu. Go ahead.
Okay, thank you, sir. If it is a small NPO,
Uh,
re-registration of re-registration is necessary. It's an automatic route. 10 years.
automatic.
Automatic. We don't have to. We don't have to do it.
We don't have to do it. No. After 10 years, we have to go for re-registration.
No. First
Now,
initially
after
5
5
years,
years,
it is automatic.
it's not. You are saying it is automatic, or you want me to answer whether it is automatic?
Sir, I applied for re-registration in 22. It is due for re-registration. Now the act says for 10 years. Whether the
Yes.
10 years take back to my case also. Should I do it now again?
Yes. You need not do it in 25. It's valid for 10 years. If it's a small NPO, automatically it goes because Finance Act 25 made that amendment.
Sir,
Finance
it means
Act 25.
22 from year 22 plus 10, 32.
Yes, up to 32. Yes, March 32.
Yes, thank you.
Sir, good evening.
Good evening,
Bhupathy, sir. This is Mani.
1 minute. Sundar Babu question I will answer. Provided your your income does not exceed 5 crores in each of the 2 years preceding this year.
Yeah, sir. Definitely.
Okay.
Each year.
Yes, Mani Megale.
Yeah.
Yes, sir. Good evening, sir. How are you, sir?
I'm fine, Mani Megale. How are you?
Yeah, fine. Sir, I have a doubt is the other person who asked the doubt, it is valid up to 26-27. Assessment year it is. So we'll have to file before September. Now.
Yes.
Yeah. So because it has
to
to
be
file.
Others can mute themselves.
Hello.
Madam,
Am I audible, sir?
Madam, your voice is echo, madam. You please check whether somebody is nearby your.
Now, sir?
Mani Megale, you are audible. Please go ahead.
Yeah. So, my doubt is they are asking for the financials of the previous 3 years. Whether we should have to apply, include even the financial year 24-25 audit report and the file statements in this, or we can go with the previous earlier audit years, this up to 23-24 financial year. Sir, am I clear, sir?
Sir, you are muted, sir. Bhupathy, sir. Sir, please unmute, sir.
Mani Megale, just give me some time. I will check that provision and come back to you.
Okay, sir. Thank you, sir.
Sir, I am Radhakrishnan from Trichy.
Yes, Radhakrishnan, tell me.
Sir, in the form when we apply for re-registration, it says as assessment year 26-27.
Okay.
But we already have the registration valid till 26-27. So, is it not necessary that we need from 27-28 onwards, or how it is, sir?
1 minute. I just reading. I am now answering Mani Megale's question. The question which Mani Megale asked was whether the 3 years accounts is only for the immediately preceding 3 years or even for the current year. 3 years from the assessment year from which registration is sought. Registration is sought. So for the registration is sought from the next year onwards. So you have to do it for March 25, March 24, and March 23, 24, 25. 3 years transactions you have to do. Even for the current year you have to do. That is my view.
Okay, sir. Now the due date for filing the return has been extended up to September.
Okay.
But we'll have to finish the financials and audit everything before applying for this registration, and then only we'll have to do the application again. Okay, sir. Thank you.
Yes. Now coming back to Radha, who asked me from Trichy.
Radhakrishnan, yes, sir.
Radhakrishnan. What's your question, Radhakrishnan?
Sir, when we try to apply for 10AB re-registration, it says applicable from the assessment year onwards, 26, 27 onwards.
Okay.
But we already have the registration valid till 26, 27.
Why should you apply for re-registration now when you got a validity up to 26, 27?
No,
because
sir,
only at the expiry of 5 years you have to apply, no?
Sir, when we got the registration in 21, it is valid till 26, 27.
Okay.
Okay, we got the validity till 26, 27. Now, September 30th is the last date for applying re-registration.
Yeah, exactly.
Is it not? But when we go to the form 10AB, when I should apply for the year 27, 28 only, not for 26, 27.
Yes, 27, 28 only. Yes.
But the form is not providing for that. Form says only 26, 27. So,
okay.
I mean,
technical difficulty.
Yes. See, I mean, the September 30th is the last date, but the form is not enabled till now.
Okay. That's right. So, technology related issue. So, that has to be sorted out.
Yes, sir. I mean, so
it is valid. I'm sorry, sir. Sorry to disturb. When it is valid up to 26, 27 assessment year, it relates to financial year 25, 26. So registration is valid up to 25, 26 March. So why should we apply for registration, re-registration now itself? Yeah,
you apply for it, but he's saying the form is not enabled. If you put that thing, the form is not enabled in the system. When he applies for registration, he is having a technical problem. The system, see, when the amendments are made in the Act, the system also has to be changed. That system has not been changed. That's the only thing. It's a technical issue which the department has to solve.
So when we have the, sorry to disturb, sir, when we have the form approval, the 10AC form valid up to 26, 27, it relates to financial year 25, 26.
Okay.
So should we apply for renewal now itself in the September, sir, for next year?
You got to apply 6 months before the completion of the registration. Before the
6 months before the validity.
Before the registration, you will have to apply. Hence, 39, 25 will be the last day.
Yes, correct.
Oh, yeah. Okay.
Okay.
Sir, good evening. I am Meena from Madurai, sir.
Yes.
Sir, actually, we got 12A registration, final registration, sir. By mistake, we have selected 80G subclass 1. Instead of 1, we have selected 4, sir. So, we got provisional for 80G. That is for 3 years, but they didn't file within that 6 months, sir. So it got validity over. So we got 12A final registration for 5 years. But 80G, it is provisional for 3 years. Anything can be done, sir?
I don't know. I have not applied my mind on 80G part of it. But, so I will not be able to respond to you on that 80G as well.
Okay, sir.
I'll check and let you know.
Yeah, sure, sir. Thank you, sir.
There's one question from Mani. Application out of loan can be considered as application of income. In that case, again, repayment. No. How? Application out of loan cannot be considered as an application, but as and when it is repaid, it could be considered as an application. Mani, your question in the chat box says application of loan can be considered as an application. No, it cannot be considered as an application. And anything, if the loan is repaid, then in that year of repayment, it is considered as an application. This is a question to be corrected. Then Venkatachalam, capital gain arising from the transfer of capital asset and the capital gain amount is applied for the objects of the trust. Can it be treated as an application? Yes, it's treated as an application. No problem. It's applied for the objects of the trust, it's treated as an application. No problem. Absolutely no problem. Many education institutions are accounting tuition fee receipts only on cash basis. It's mandatory to follow. Yes, sir. Rajesh, CA Rajesh. Many education institutions are following the cash receipt. This is a problem which we are facing. Some of the education institutions have come to us also and asked us to accept a cash based of accounting. We are very clearly telling them that we are bound by the guidance note and we have to follow the accrual system of accounting. The problem comes mostly in the case of admission fees. They are collecting huge admission fees, and admission fees in the year of receipt they have to offer it. So this is a problem, but the guidance note is applicable for us, so we cannot overrule the guidance note. It's a practical problem which we are facing, and we have to, unless the guidance note is changed, we cannot do anything. Yes, this question has been answered, Radhakrishnan. All the trusts whose registration is valid till 26 have to apply for registration. Yes, 30th September. Form is allowing, yes, this is only the same problem. Yes, that's right. Raghavan is saying renewal application is 6 months before the expiry. Supposing you got the registration after 21, 6 months before the expiry, you should apply for it. A trust already received unsecured loans from trustees in earlier years. Use the loans for purpose of investment construction of buildings. Now, trustees want to waive off the loan. In that case, the waiver will be considered as income in the year of waiver. That income cannot be applied in the year of waiver or income. Problem. Govinda Rajan's question. Good. Any other thing? First question only I have not answered. First question is public religious trust would come any other object of general property or can be brought on a place of historical interest. Religious. The charitable purpose definition talks about education, medical relief. So it is not talking anything else. So if it all come under any other activity, it will come. Not come under anything else. Let us take the specific words there. It says relief of the poor. Religious activity is not relief of the poor. Then medical relief, preservation of environment, including water, forest, preservation of monument, places or objects. Artistic or historic interest. Artistic or historic interest, you can count. Artistic, instead of coming under general public, artistic or historical. It could come there. Good. Okay. Any other questions? Ganesh?
Sir, nothing, sir.
Okay.
Rani? Rani?
Sir.
What else?
Glad so many people have participated and we were able to reach out to some. I do not know whether some of the intricate points have been covered, but please be careful about 9A. That's the warning signal I would like to give. How you fill it up and how you fill up the return form, ITR 7 also. ITR 7 is yet to be notified, I think. You have to check as and when.
Rani?
Thank you, sir.
Thank you. Thank you.
Thank you, sir. To conclude this evening's proceedings, I request the CA Satish Kumar, Chairman of Madurai Branch, to propose the vote of thanks.
Yeah, hello everyone. So I'm Balamesh, Secretary from Madurai Branch. So I extend my heartfelt gratitude to distinguished speaker CA.R.BHUPATHY sir for sharing their deep knowledge and practical insights and guidance on the important aspects of this ATG and toll registration, sir. Thank you, sir. Thank you very much. I also thank to all our participants to engaging this session wonderfully. And I also thank Kumbakonam and Tiruchirappalli branch, Kumbakonam branch chairman CA Ganesan sir and CSK Prasanna Kumar sir secretary and Tiruchirappalli branch chairman CA Vidubala Satish ma'am and CA.R.BHUPATHY sir secretary for this organizing this wonderful session. And hope we have a great day and we look forward to participate in future events. Thank you, sir. Thank you very much.
Thank you, Ganesh. Thank you, Rani. Thank you, everybody. See Ganesh.
Okay,
thank you. And kindly update my CPE program also, CPE points also.
Sure, sir.
Okay, thank you.
Thank you.
Thank you, sir. Thank you very much.
Thank you, sir.
Kindly share the presentation, sir.